Good morning and welcome back. I know I'm a little delinquent in getting the next video out, so my apologies. We were in the process of launching our website, a new website, so hopefully you've had a chance to see it, investfortomorrow.com. The URL hasn't changed, but the website's totally new. Working through some kinks as normally happens. At the same time, we are migrating to new servers, and that has been less challenging than I thought, but still with some bumps and bruises along the way. If you're a blog subscriber and you go to investfortomorrow.com, you'll see the blog under the insights portion. I'm working on getting my daily notifications for blog postings better, more efficient for you to click versus having to go hunt around the website. So thanks for your patience, and I love the constructively critical comments. It certainly helps us. Most of the comments I've addressed literally within minutes or hours of receiving them. So thank you. Keep them coming. We want to build the best website. We want to communicate the best that we possibly can. So thank you for that. Today, we're going to cover a couple of quick things. I'm talking about the Fed, obviously the market, and a little bit of economy. And finally, if I don't forget, we'll talk about Hertz rent-a-car, which I'm sure many of you understand why I brought that up. And no, it's not because I'm going to rent a car. I don't have any plans to travel anytime soon, although I continue to fight with American and United, whom refused to give back my cancellation fees from early March. Americans was something like almost $800. And United, I've gotten down to 100 or so. So I'm getting better. Delta, thankfully, gave me all of my cancellation fees back, which is nice. I mean, Marriott, to their credit, refunded all my money for my prepaid reservations. So I thought it was very nice. But American, I just keep fighting with, and they're so awful. And first of all, I think their service is awful, but I always wonder if it's because I've always been critical of their CEO, Doug Parker, in that he always seems to whine about something in interviews. He's never kind of is the adult in the room and just takes what's coming. Listen, they had $40 billion of debt coming into the crisis, and they spent so much of their free cash flow on stock buybacks, perfectly legal, but they made that decision, and now they whine and they wanted a government bailout, which I think is absurd. There's a reason for bankruptcy courts, and that's where American, I think, belong. So clearly the government thought else, and that's okay. That's just one man's opinion. All right, so let's talk about the Fed. As I do this video, I'm going to point Jerome Powell is speaking up on the TV behind my screen. So the Fed's going to keep rates at zero for a very, very, very long time. I think the stock market will be perhaps at 40,000 by the time the Fed begins to raise rates. That's a long way away. Yesterday, which was Monday, June 15th, very curiously, in quotes, and I'm not accusing anyone of manipulation, mind you, but very curiously, the Fed came out and announced they were going to, instead of buying corporate bond ETFs, exchange traded funds, they're going to now go into it and buy the individual corporate bonds. And that's okay, nothing wrong with that. But I thought it was funny, curious, quotes, interesting. They chose to announce that in the middle of a trading day, while the instrument that they trade, which I'm going to pull up, was at new highs. Now, for those of you who are going to say, well, that's just sour grapes because he didn't own it. Well, in our bond portfolios that own high-grade corporate bonds, I'm going to share my screen. So in this is the LQD, which they were buying, and now they're buying the individual bonds. That was just at new highs already. So it's not like they announced it when the bond market was struggling. They announced it when it was at essentially new highs. I find that to be a little curious. And they did it in the middle of a trading day. Also a little bit curious. So with that, I guess I can leave that up for the time being. So Powell's testifying now. I mean, he has become what I think is the greatest proprietary trader in history. They've thrown all caution to the wind. I thought they did a very good job addressing the crisis and responding initially with all those programs, the alphabet soup programs. But once they decided to buy junk bonds, I thought they went really outside of what they should. You shouldn't reward people. And look, I took plenty of risk in the first quarter, and in a number of our strategies, we got hit over the head with the ugly stick. That's part of investing. I'm sorry. If you take the risk, sometimes you're going to lose and you're going to be punished, as you should be. But to now bail out high-yield bonds, high-yield corporate bonds, junk bonds, I think it's flat out wrong. I'll say it until I go in the grave, hopefully many decades from now. But I think it's just flat out wrong, because that means you're one crisis away from going to do what Japan did, Japanification, and go buy stocks. The Fed should not buy junk bonds. They shouldn't buy stocks. Now I'll move on. So Fed is really in the markets today, which again, I don't have a problem with, as long as they stick to their knitting and not get outside their sandbox, which I think they're doing. Let's move on. So let me go to, while I'm on the economy and the Fed, quick comment. The economy is reopened. The numbers are much, much better than expected by most people. Certainly better than I expected, but I still don't think the economy is going straight back to new highs. The market is not the economy in real time. The market is the economy 3 to 9 months down the road. So to detract for a minute, people say, they continue to ask, why are stocks doing A when the economy is doing B? It's because the market's forecasting what the economy is going to do down the road. And don't forget, the Fed dropped many nuclear bombs on the economy to get it going again. And that is in turn compressing the moves in the market. What would have taken, so that decline in March, that was a 4-week decline, would have taken in the old days several quarters or maybe even a year to decline. Everything is compressed. As we came out of that, and Jay Powell and his friends do that nuclear bomb on the markets, the moves are compressed as well. So I don't believe, I say this pretty confidently, I don't believe we will ever close down the economy again. We learned that we shouldn't have done it like we did. And I thought it made perfect sense from a health perspective. And I'm probably as afraid of the virus and as cautious as many people who are not in that high risk category. I'm still pretty cautious, as my friends will tell you as they laugh at me. And I'm like, I'm fine. Laugh at me all you want, but that's how I am. And that's how my family's going to be. In any case, I don't think they will ever close the economy again. As we got through the virus, the heightened portion where we're worried about the healthcare system, I said, okay, now we flatten the curve, but nothing is going to change medically until we get to Q3, Q4, Q1 of next year. Sure, the hospital will be prepared. Sure, it will be PPE. Sure, we will have some experimental treatments, but nothing that's a game changer, seminal change that will say, okay, ring the bell, everyone go outside and go to games and concerts and all that kind of stuff. I don't think so anyway, but I digress. So I don't think we're going to ever close down the economy again. God forbid the virus comes back and it's stronger in the fall. I think they will surgically or tactically close down certain high-risk people or people who are frankly more cautious, but I don't think the economy is going to ever close down again. I think when you look back, and this is not a good comparison, so don't attack me with this, but it's the best I can come up with. I think when George Bush II was fed the wrong information about the weapons of mass destruction, it led him to make a decision to go back into Iraq. I believe that Trump was given, I don't think intentionally, but I think he was given the wrong information from that very, very flawed Imperial College model. And I think he acted and the governors acted on what was an incredibly flawed model on how the virus spread. I'm not an epidemiologist nor a virologist. I can't even spell them, frankly, but that's my opinion. All right, let's move on. So the economy collapsed and is now sharply recovering, although I think the recovery is going to stop well short of the highs we saw in February in the economy. So it is going to be a very sharp leg of the recovery, but I don't think it gets all the way back to the peak until at least 2021, 2022, maybe. I don't think 2023, but we'll cross that bridge down the road. Yes, so the last month or where are we, June 16th. So the last month or so, I've said, I do think a new bull market launched on March 23rd. I didn't think at the time. I did talk about a bottom forming right around the 23rd, 24th, but I clearly did not think we would have this robust a market recovery. That's okay. I mean, I've been magnitude wrong before, and I'll be magnitude wrong again. It comes with the territory. Some days we come in and things go really well, and we're positioned very, very well. And other days you come in and realize you're the bug and instead of the windshield. And being the bug is just never fun. Market-wise, I suspect right now, I'm going to go back to my screen for you, and I'll pull up the Dow. Why not? Let's go back and share my screen. Oh, I am screen sharing. Oh, boy. All right, it's one of those days, so my apologies. Here's the Dow. And I suspect that the June highs, which right are here, and the June lows will basically hold for a while. I think we could kind of bounce around sideways. Maybe poke briefly above, poke briefly below, but I think by and large, we are going to stay in a higher range than this range. That's okay. The last couple of blogs, I compared 2020's launch of the new bull market with 2009. If you haven't seen those two blogs, well, I think most of my blogs are good, but clearly I wrote them, so I can't think they stink. Go back to investortomorrow.com, go to the insights section in the blog, and you'll see how I overlaid 2020 with 2009. You can see where we are in the process. This last pullback has come almost perfectly in that it was the upper single digit magnitude similar to 2009. So 2009, we went sideways, we pulled back, and then we shot off again. I think all price analogs break apart. This one will too, but I think it's got a little more legs to it than ending right here. So stocks are okay. I think the theme would be to be kind of quaint, buy the dips and sell the rips, buy weakness and sell strength. And I think until I'm proven wrong, which at some point I always get proven wrong, until I'm proven wrong, I think that's fine. I think that will serve you okay. Buy the dips, sell the rips. So we talked about, let's see, the Fed. We talked about the economy a little bit. We talked about the market. I want to pull up Hertz. I'm going to go to a different chart to do that. There we go. So here is Hertz. If I'm still screen sharing, yes, I am. Hertz, rumors of the bankruptcy were true, and Hertz is going into Chapter 11 bankruptcy to reorganize. In all likelihood, if you own the stock, you'll be wiped out in all likelihood. And then bondholders will own the company, and they'll rework the company and issue new stock, blah, 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 yada, yada, yada. What's been fascinating is, as the last couple of weeks, as I'm circling here, you can see insane amounts of volume, hundreds of millions of shares. And you also see Hertz soaring from 40 cents all the way to $6.25 amid a bankruptcy filing. I can say, I've never seen that before. And I mean, once a stock gets beaten down like that and looks like it's going out, I don't even look at it anymore. Similar to Chesapeake, another stock that's likely headed into Chapter 11 bankruptcy. And a lot of this is tied to that online free trading platform called Robinhood. There's many reasons why this could be happening. I didn't make this up, but I can't give credit because I forgot who said it. But I think the person who said, because there's been no sports and there's no online sports betting, because that's a multi-billion dollar industry, a lot of the bettors, the gamblers, if you will, are turning to kind of penny stocks and super high risk stocks like Hertz, and to fill their gambling obsession, passion, need for action. So when a stock goes from 40 cents to $6 in a couple of weeks, that's gambling. That's kind of crazy. So that's what some people are speculating. It makes sense intuitively to me. We'll never prove it right or wrong, but it certainly makes sense. And I think as sports, golf came back last weekend, and then the NBA is coming back. I pray that baseball is going to come back, and we know football is coming back. So as things come back and betting starts again, we'll see if the Robinhood fascination is a fleeting fancy. But more importantly, when I see Hertz and Chesapeake have those moves, I don't think the whole market's in a bubble. So don't come at me with that attack. But I do think action like Hertz and Chesapeake are so reminiscent of the .com era, where stocks with, and I forgot that Nikola stock. I forgot about that. No revenue, and there we go. Has no revenue, and we rallied from roughly 10 to 90 in a month. God bless America. So this very much, those three cases have the feel. If you want to know what it was like in the .com era, that's what it was like when stocks went from nowhere to somewhere in a short period of time. Nikola, Hertz, Chesapeake. I'm sure there are more, but those are the ones that seem to be in vogue right now. So now I'm going to stop sharing my screen because the video is getting too long and you're probably getting sick and tired of me. That's it for, whoops, there we go. That's it for today. So we talked about the Fed, we talked about the economy, the new bull market, Hertz, Chesapeake, Nikola. I think I should probably do one on sentiment, because I'm seeing so much short-term sentiment, which is screaming warning sign like the .com era. And I'm seeing longer-term sentiment, which is on the other side, which is still hunkered down in the bunkers with bottled water and spam. So it's interesting that we've got a dichotomy of sentiment, and it all depends on the time frame you're looking at. So that's it. Again, check out the new website. I'd love your constructively critical feedback. It's the only way we're going to make things better, because I don't know, I'm not an expert, and I look at things so much of my own that it becomes, I don't see the flaws in it. So I want to know the flaws. Please feel free to send them over. And I think that's it. Thanks for watching. Oh, as my buddy Tiny would say, if you like what you saw, give me a thumbs up on YouTube, please. And hope you're safe and sane and enjoying what has been a beautiful spring, albeit very windy in New England. I will be back soon. I'll be on Yahoo hosting in an hour, which I will send an email shortly. Thank you all. I have to figure out how to stop.